If you watch Shark Tank India, you must have heard the term valuation. So what is valuation? In market, everything has financial value. Your house, your car, even your mobile phone. Each has a price based on what someone is willing to pay for it. Similarly, a startup also has a financial value. But here is a twist. Unlike a house or a car, startups don't always have a fixed price tag. Their value depends on how people perceive their future potential. Investors put money into startups today because they believe they will make more money in the future, similar to buying shares in the stock market. Imagine you want to buy a mango tree. Today it's small, it doesn't give any mangoes. But the nursery guy says this tree will give 1,000 mangoes per year in 5 years. Now, how much would you pay for this tree today? If you believe him, you might pay 10,000. But if you have doubt, you might pay only 2,000. Same tree, different valuations. The price is based on how much you believe in its future. Startups work in a similar way. If an investor, after due diligence, believes a startup will make 1,000 crores in the future, they are willing to invest in that startup at a higher valuation today. If they don't believe in the growth, they will either invest at a lower valuation or not invest at all. For investors, valuation is not just about how much they invest, but also about how much they will own in the company. If a startup is valued at 10 crores and investors put 1 crore, they own 10% of the company. But if the valuation is set at 100 crores, the same 1 crore will only gives them 1% of ownership. So every investor negotiates for a valuation, and that's why startup founders and investors always argue over valuation. Founders want it high, investors want it low. But remember, high valuation doesn't mean a startup will succeed. Just like a low valuation doesn't mean it will fail. What truly matters is whether the business can grow sustainably and turn that valuation into real value over time.